Hey, Mike Swanson here. It's 6 o'clock in the morning. The futures are gapping down. That seems to be confirming the stuff I was writing yesterday. And of course, it's Spain, you know. And interesting enough, though, the Greek stock market, it's down 6%. But anyway, usually the first thing I do every morning is answer emails, and I got one I want to talk to you about real quickly from this person. Last week, he saw the video where I was talking about buying stuff for the long term, investment positions, and then yesterday, of course, I put out this report saying I thought the stock market was going to drop into the fall, and I'm not going to buy anything till that takes place. That's right. And he thinks this is confusing. How can I say I'm going to buy last week and then yesterday say I think things are going to drop? Well, my whole notion of buying to invest is predicated on my belief that the stock market is going to have a correction, that it's actually in a correction that started in April. And I think all we've seen is a short-term bounce. But this is the important thing. I don't like investing in the stock markets that have gone up for months on end, or for weeks on end for that moment. But to invest, to buy and hold, the best way to do that is to wait for corrections of 10%, 20%, even sometimes 30%. Some markets actually, like gold, even when gold stocks had big years, it usually corrects once a year about 30%. Of course, it's fallen much more than that since the fall. Well, the thing is, most people don't do this. They get excited after things have gone up, and they buy into tops. You want to wait for corrections and let them show you where the strength is in the market. You see, if the market pulls back here over the course of the next couple months, some sectors will hold up. And that's what you're going to want to invest in, because those are the sectors that usually perform the best afterwards. And right now, we've seen bear markets all over the place. Now, the U.S. market has been the strongest market in the world, pretty much, for the past year and a half. And there have been bear markets elsewhere. Of course, Greece is a bear market. Spain, Italy, much of the other European markets, emerging markets, China, Latin America markets, gold stocks, bear markets everywhere. And people don't realize that's what's going on, that the U.S. has simply been the strongest market. And it's my belief that this global bear market is going to end in the fall. And the last phase of that bear market is going to involve the U.S. stock market falling too. I'm not saying it's going to crash. You got the word crash in there. But I think it can fall to like 1,200 or something, S&P 500. Some people think that are going to feel like that's a crash because they'll be shocked, but that's their fault for having a silly belief that things go up all the time. Here's the reality. The stock market, even in the most bullish of years, usually corrects about 10% at some point during that year. We already saw something of a correction in April and May. I just don't think that correction is actually over yet, and we've just seen a short-term counter-trend bounce. So I'm not really saying anything different last week from what I'm saying now, and that's what I'm afraid is confusing. If you're confused, then others are confused, right? So I invest after drops, and I'm saying I'm looking for a drop to happen before I put my money in. I'm not saying things are great, so let's buy now. I'm saying corrections create opportunities, and I plan on taking advantage of that. Now, yeah, I mean, today the market is gapping down. I'm sure I haven't even turned on the television yet. But I'm sure there's some people sweating. Here's an even picture of this guy crying right there, right? Of course, that's probably a stock photo, but you know. And I'm sure if you're holding stocks, you don't like this. And here's the thing: I don't think the stock market's gonna. The odds of it going straight down, you know, from here aren't very likely. In fact, short term. Look, you look at the market in different time frames to analyze it. The daily chart, the weekly chart. That's what I'm want to invest in, right? And that trend peaked out in April. And you got to look at the chart and step back to see that. And people don't do that, right? So they just look at the market day by day, and it went up in June, so they forgot about this weekly trend, or they didn't even realize about it, and now they're shocked, right? Well, that's not how you want to be. Well, let's talk about the hourly trend, because that's what we're looking at when we cut on this monitor. And now right now it's down, it's gapping down. Well, those trends, the hourly trend can change, and good chance it'll fall today. But if it does on an hourly basis, it'll be oversold. It'll probably go up Tuesday or Wednesday. And look, Apple has earnings tomorrow. So even though it's down today, I most likely will see some excitement, temporary excitement at some point this week, and gap ups and whatever. You know, I may even take a short position if that happens. But anyway, my main focus is the weekly trend, and I'm going to take advantage of that. And because, look, there's stocks that have fallen for 2 years. In some cases, shipping stocks have fallen for 2 years. They're paying 10% dividends, some cases even more than that. There's a telecom company in Portugal paying a 20% dividend. It's like $3 or $4. And when things bottom out, that stock will be up to 10 in months. That's where you make real money in the stock market. You don't make it by putting on this crap on the television and jumping in and out. Okay? Not in this kind of market. 10 years ago, you can make a lot of money day trading. Now, not so much, right? So, anyway, I hope that clarified things, that I wasn't bullish last week when I said I'm looking to invest in the stock market. I'm planning on it. I'm preparing to do it. Okay? And I'm hoping my preparation will help you be able to take advantage of things too when it's really time to get into this business or get into this market, to hold it. You can trade it. You want to gamble on a bounce that it'll go up for a day or two? I wouldn't do it right on the open. What I would do, though, if you want to make those kind of gambles, is I'd go here, Yahoo Finance, I'd click Market Overview, I'd scroll on right here, up volume, down volume, and look at like 3 o'clock, and if down volume's over 90%, and you want to gamble that things are oversold on an hourly basis, I look for down volume to get to 90% and take a position and, you know, hope things bounce for a day and do that kind of short-term trading. The reason I'm not doing that is that when you take a trade, there's 2 risks involved in it. Of course, there's money you can lose, but the other risk is more important, and that's the risk that because you lost some money, you now have to get more cautious, or you can be psychologically a little beat up a little bit and get hesitant, and then you miss out on a better opportunity when it comes. So that's why I don't really want to do this short-term trading, because I know that the real opportunities are to buy these stocks like $3 or $4 when the time is right, get the big dividend, and make a giant return. You know, if I fiddle with this thing, then I can miss out on this market. It's got like a You know, I can miss out on buying that or this. A PE of 4, trading at $11, is probably going down to 7 or something, and after it bottoms, it'll go up 100%. I like to try to make 100% instead of like 0.1% and flip coins. Okay. So anyway, be talking to you soon. Again.